again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is Tuesday, the 24th of May of 2022. Markets are moving. Let's get into our market insights and observations, and thanks for watching. So right out of the gate, we have markets are down today on the heels of a price action, a nice rebound on Friday as well as Monday. And then here today, markets are continuing the sell-off. Again, we're in bear market territory, and that's technical by the S&P, the NASDAQ, and the Dow Jones Industrial Averaging closing more than 20% down. Now, S&P has flirted with the 20% mark, about 19.9 so far year to date. But ultimately, if you look at all three indices, we're in bear market territory. And ultimately what that means is that when you're in a bear market, you have to watch the close, not the open. We've seen markets open and they scream up only to sell off into the last hour or two in the trading day. And so we're watching actually price action for today. On Tuesday, markets open down and they're grinding their way sort of, I wouldn't say higher, but they're not accelerating into the down as I speak, or at least record this right now. So there's some constructive movement in the markets right now. Again, when we balance and rebalance, we've got cash to put to work, but we're being cautiously optimistic as we're going through this bottoming process through this bear market for our clients here at Blanke Schein Wealth Management. Now, I'm repurposing the board. What I ultimately discussed last week, it's still playing out. You know, are we there yet is one of the questions from our clients. And ultimately, the bear market sell-off, you know, out of the three things that we're looking for, we're still at two of the three we haven't checked off the box. The only one is basically the volatility forced selling index, the trend. Not to get too technical, but we were well over the 3.0 reading. We're at 3.5, but we're still looking for the VIX. We're in the mid 30s right now. VIX traditionally for a sell-off to be done, you're in the 40s or higher. And the put-call ratio, we're close. We're getting at 88%, not quite there yet. Last week we were at 85. We want it to be 90% or above. That just means that 9 out of 10 are being sold to the downside in terms of the listed stocks on the exchange. So those are the three indicators that we're still waiting for. But again, we're inching closer, and that's really good. And why you sit tight and hold on to high quality right now, or upgrade your portfolio in the meantime, is because we got days like last week where you have 1,000-point up day. In fact, we have a lot of selling pressure, but there's also a lot of unembedded short pressure. And so as soon as you get good news here and there, you could see 1,000-point, who knows, 2,000-point up day all of a sudden, because the shorts have to cover, even though there's a lot of pressure on the market as we go through the bear market on the downside. That being said, real estate didn't look too good. In fact, when we showed this report last week, we talked about existing home sales, and it's a tight supply pushing prices up with a 2.2 month supply for real estate in general. But today we've got the new home sales, so the contracts in April, and ultimately that read was a big miss to the downside, 16.6%. Ultimately saying that we're having a slowing in the new home market. Now, that's a discretionary purchase. That's a large purchase. So that's impacting the consumer, and the consumer's definitely being impacted greater than that. In fact, if you think about it, especially in the mortgage market or in the refinance market, year to date, we just saw, if we start the January looking at a mortgage, you're in the mid 3s, and now you're in the mid 5s. Ultimately, what that translates into to the consumer, the U.S. consumer that's shopping for a home right now, if you look at a $450,000 average price of a home, that's what we are here in the United States right now. That's an additional $5,000 to the bottom line for that consumer. And that's really impacting the bottom line. It's going to impact housing, and it should slow real estate just a little bit. And in fact, that's what the Fed wants to do. The Fed wants to induce a recession. That's one of the only ways they can actually ultimately fight the higher costs of inflation. Now, you and I, we all know we're looking at corporate America, we're looking at our balance sheets, we're looking at our kitchen table, we're looking at our grocery stores, and what we're spending money on, everything's going up. In fact, to get it from point A to point B in the supply chain, that requires diesel. And diesel and unleaded fuel, in California, we're anywhere from 6 to 7, soon to be $8 because it's Memorial Day weekend coming up. It's a big travel holiday. We could see that touch, just unrealistic but almost surreal prices right now in the energy complex. Again, that translation for every kitchen table right now is additional $5,000 out of their discretionary spending. So it's going to hit new homes. It's going to hit the corporate balance sheets, right? So discretionary spending is being taken out. Now, it's literally like the potato chips. We were talking to a client today, and he was talking about the potato chips that they have to supply in sort of in one of their stores, and he goes, the price of that is just tremendous. Obviously, it's being passed on to the consumer, but at the end of the day, it's because the point A to point B, getting that trucker and that truck driver, it just costs more. Therefore, the chip company embeds it in the cost, and they pass it on to the consumer. So every single way, energy is part of this economy, and we have to watch energy as it continues. Now, on the other side of that, we're continuing to allocate more for our clients in the energy complex. That's we believe, a sector that will outperform, because there's always a bull market, even though we're in the throes of a bear market. And so there's always something that could perform and outperform on a relative basis. So we really like that exposure there. But we're going to continue to watch rates. We're going to continue to watch the Fed induced recession right now, because they're trying to slow energy. They're trying to slow real estate. They're trying to ultimately crush inflation every which way. But that really could be too little too late, because inflation is already embedded in the supply chain, as we said, with energy. It's also embedded with, let's say, new homes. The new home builders learned their lesson from 2018. Now, is real estate going to crash? We don't believe so. In fact, from then, you have a lot of home builders that are now tightening supply, much like the energy complex. Or is energy going to crash? We don't believe so, simply because, obviously the administration right now is energy independence, but we're paying for it in 2022, even though 2030 is a long way away. You can't just turn off the spigot and say, let's plug in, when we're ultimately not prepared to plug in. And so ultimately what happens is the back then, when the last energy boom and bust crisis was, energy CEOs and executive teams were compensated by the amount of production. So they produced on the way up and they produced on the way down, and a lot of them went out of business. Well, they changed that. The executive compensation for energy companies right now is on profitability. So ultimately it's to the shareholder. So that's why we like that sector in general, is because energy could be over 100, which it is today, dollars a barrel. It could be plus 70. If it's plus 70, energy companies still make money. They're highly profitable at that standpoint. So there's a lot of sort of margin of safety, if you will, for companies in the energy complex to be quite profitable on a go-forward basis. On the other side, the home builders. While home builders are feeling the pain right now with drops of sort of the new applications, they're going to also control the supply. Post 2008, they oversupplied the marketplace, and look what happened. Real estate market crashed as a result. Now the home builders, both big and small, are ultimately controlling and sort of piecemealing out the housing and the new housing market itself. That's going to cause more inflation, because there's less. It's a supply and demand issue. So housing may maintain. There might be realistic expectations on some of the real estate side for residential. People who are selling their house, right? Seller's market, they might have to come down to earth. And obviously, if we're looking at Zillow, over 50% are in the correction territory, at least coming down from expectations. But that's okay, because if you look at housing prices and costs year over year, they've gotten out of control. Let's all be honest, especially even if you're selling and even if you're buying, we can't have that continue and have a healthy market. So the equilibrium hopefully is going to take hold within the real estate market. We just need it to go over to the energy complex, and that could take some time. So there's some sectors that we like, some allocation that will work, that we believe will work in a bear market that we're in. So let's keep an eye on this. Again, we still need a couple of factors to say, hey, are we there yet? So let's keep an eye on that as well. But that's it for us for Blanke Schein Wealth Management. Thanks for watching. And again, until next time.